So in this video, I'm going to show you how I would start my day trading career over again if I had to start from scratch. Now this is before getting to where I am now, where I have an entire fleshed out profitable system, where some days I'm profiting $5, $10, even $15,000 per day. But the truth is, I wasted so many hours, if not years, where if I knew what I know now, I wouldn't have needed to do that. So that's my goal for this video, is to give you as much as I can to ensure that process from where you are now to where you want to be is moved through in the fastest and most efficient way possible. Okay, so I'm going to break this down as simple as it needs to be done. We're looking at gold here represented on a line chart. And as you can see, we're moving up. So the value of gold is increasing. Now, if we switch over to the candlestick chart, you can see the exact same thing, but represented with green and red candles. Now, green is going to represent the value of gold moving up, and red is going to represent the value of gold moving down, because that's what markets do. They don't move in a straight line. They have pullbacks and then they have continuations. So the question might be, why does this happen? Why does the market move up and why does it pull back? The simple way to put it is that there's retail traders like me and you sitting at home placing buy and sell orders. There's banks, there's institutional traders, there's hedge funds, there's a bunch of participants in the market. And the overall way I want you to think about the market is essentially that it's a tug of war between buyers and sellers. That's all. Now within this tug of war, the market actually creates opportunities for us to place entries and exits and actually make money here. Because believe it or not, this is just mass human psychology represented on a chart. So within that, repetition and patterns start to get created. And within those patterns, we can find opportunities. So now that you understand the basics of reading a chart, let's go over the math and the logic behind what it means to take a profitable trade. So how this all works, it's simply about how much you're willing to risk to how much of a reward you're looking to get per trade. So if I enter a trade here, I'm looking to risk $100 to make $100. In this case, I'm willing to risk $100 to make $150, right? I've extended it now. I want to get more out of this trade. So if I enter a trade here, I'm anticipating it to come down here and give me $150 out of it. And finally over here, I'm looking to risk 100 to make 200. So I'm anticipating this trade to come all the way down and make a $200 and only risk 100. Now the question might be, well, why not just risk this every time? Why not risk 100 to make 1,000, right? Why stop at 200? And the answer is, markets don't move in a perfect straight line. Like we spoke about before, it's a tug of war between buyers and sellers. So markets typically move up and down and up and down. It's not in a straight line. So within those up and down movements, the probability of it coming up and hitting your stop loss is much more increased if you're looking to get such a big move out of it, as opposed to something like a one-to-one risk to reward, where I enter here, the probability of it coming down, hitting my take profit, and then maybe later on moving up and hitting the stop loss is much higher. The less I look for in terms of profit, the higher probability it's probably going to get there. Now, it's important for me to note that your RR doesn't necessarily determine whether you're going to be profitable or not. There's people with a negative RR, meaning they risk more than they're going to get out of a trade and are still profitable traders. So there's no right or wrong. It's just you have to understand what's best suited for you. Now let's take a look at this concept in real time before I show you an actual trade I took. If we look at this chart here and let's say I decide to take a buy position here to target this level up here, put my stop loss here. So I'm risking about a 1-to-1. So I'm risking $100 here to potentially make $100. My entry is right here at this green candle and I'm targeting up here somewhere. The candle starts moving, it hits my take profit. Beautiful, I just made $100. I'm out of the trade now. But remember what I spoke about before, where if you look to take the bigger risk to reward, which is maybe a 1-to-2, now I'm risking a 100 to try and make 200. Look what happened. Price came up, it didn't reach that high, and then what happened? It came back down and hit the stop loss. So that's where it's important to understand within your strategy, your RR or risk to reward parameters, because the reality is the more you try and get out of a trade, the higher the probability it's going to do something like this and come back and hit your stop loss. So right here, I'm showing you a replay of a trade that I took, which was around a 1-to-1 RR, made me close to $4,000. And you can see this going to be played out in real time here. So entry goes there, stop loss goes up above the current candle, take profit moves down to about a 1.3 RR, and entries happen and just let the rest play out. You see we're moving down here, just let the market breathe, let it do its thing, and let probabilities play out. So around here, you could go to break even, or you could let it play out, and there's target hit, and that's it. That's it, rinse and repeat. And we're going to get into the strategy stuff in a bit, but it's important just to show you how this looks in real time. Now, these are the trades and the setups that I take every single day, and they do show up every day. Does it mean you're going to win every trade? No. But over 100 trades, I always come out on top, and that's the game of profitable trading. So before we get too far into strategy stuff, let's talk about the tools and the websites and the things you need to know before jumping too far ahead. Okay, so the first thing you're going to need is TradingView. This is the platform you'll use to actually view the charts. You don't necessarily place the trades here, but you do use it as a platform to easily move through and view each chart and each asset you want to trade. The second thing you need to do is decide where you actually want to place the trades. Now you have two options. You have prop firms, which is you use somebody else's money, or personal, where you use your own. So my favorite one is Top Step. You can see right here, Top Step, which is a prop firm, trade our money, right? Or my personal account, which I use Tora Markets, which is a platform that allows you to deposit your own cash into this account and trade with it. So you can see right here, I've got 31,000 in my account, started with 5,000 and worked my way up. The next thing you need is a website called forexfactory.com. Now this is going to tell you when high impact news is going to be released and the severity of the impact on the market. So I know if I watch gold at 5:30 p.m. today, that red folder news is going to be released and it's going to have a high impact on the market. And typically what you'll see is something like this. A massive spike. So similar to this, you'll see a massive spike in the market. So I know, hey, stay out of the market at that time. Now the next thing you'll need after that is your trading journal. But basically what this does, it allows you to track all of your trades. You can collect all your statistics and your data. You can check the trades you took. You can filter it down. I can find out on a Monday when I take a long position what my statistics are. So it's really important to track your data with a journal. Now let's go over some fundamental terminology and just some things that you need to know to basically move through these charts with a better understanding. So in TradingView at the top left corner here, you can see I'm on Bitcoin. Now, the correct terminology is that we're looking at a pair here, which is Bitcoin, BTC against USD. So BTC being the primary and USD being the secondary. So it's Bitcoin against the strength of the US dollar. All the biggest movers are typically against the strength of the US dollar. You can see to the left here in TradingView, I've got these ones saved. So you'll see a little banner pop up there and you can tab that and that's immediately going to be in your saved section. So when I come into TradingView next, I can immediately click on XRP or whatever pair I want to go to as a default. So when we're looking at a chart here, at the start of the video, we're on the line chart, but the candle chart is where we really want to be paying attention to. And I'm going to go into detail now with why exactly that is. So candles give all the information we need to be successful day traders. And I'm going to show you exactly what I mean by that. So check this out. So it's important to understand the basic anatomy of what a candle even is. So as you can see here, the candle opened at this point. Then it moved all the way up to this high and pulled back and closed right here. Now the exact same, but on the opposite end, the bearish candle opened up here, moved all the way down there, pulled back and closed here. And that's the basic anatomy of what a candle is. The wicks represent an area where price once was, and the bodies represent the open and the close. Now these candles actually give us a tremendous amount of information. As a price action trader, I actually solely rely on the structure of the candles to give me the information I need to take profitable trades. Now let's have a look on the chart and I'll show you the importance of how to read these candles to identify what could happen next. So at the top of your screen on TradingView, you're going to see the time frames here. Now each time you click on it, so 30 for instance, each candle is going to represent 30 minutes. 1 hour, each candle represents 1 hour, 4 hour, and so on. So if we sit here on the 15-minute time frame, we can see that this candle, for instance, opened up here, moved all the way down here, then all the way up here and closed here. So we had a massive candle movement around here. The red candle did the same. But remember what I said before about the candles actually leave clues as to what might happen next. So if we know that multiple times price tried to push up here and rejected and failed to do so and end up coming back down into that range, this could give an indication that it might be a good opportunity to sell here, because look what happened over here. The same thing. We failed, failed. Each time that happens, there's a probability of price rejecting off and pushing down. Same with the bottom. Failed, price pushed up. And now you can start to see, if you put the pieces together, you can build a story as to what may happen next. Now I'm going to tell you about the biggest thing that's going to determine whether you find success in trading or not. And it's you, your trading psychology. I've mentored hundreds of students and I've even had to overcome this myself, but the biggest determining factor on whether you're going to find success in this game or not is your ability to understand and control your psychology. What does that mean? Most traders fall into a few categories which I've got marked here. Impulse trade, revenge trade, and overtrade. Now you might say, hey, that's all well and good, but not me, bro. I'm way better. I'm different. Let me tell you something. When you're trading these markets and there's real money on the line and real emotion on the line, feelings are going to come up that you haven't had to navigate in a long time. So it becomes your new duty as a professional trader to not only manage the skill of trading, but also manage yourself. Now, it's all good to talk about trading psychology because most new traders don't believe it's actually as important as it is. So I want to show you something here. Have a look at this. I was once where you are. The idea of having a $10,000 day was once a massive dream of mine. Now I've done it so many times and have the consistency that I always wanted, where once upon a time, it actually looked like this, blowing account after account after account. I would do this every time where I would be trading okay, but on one day, everything would go south and really just falling a victim to everything I just shown you over here, which is I would fall victim to the impulse trading, the revenge trading, and the over trading, like so many traders do. It wasn't until I decided, you know what, I need to take a step back and actually try to understand my psychology on these markets, understand why I do the things that I do, did things start to change. Okay, so now I've covered a lot of the basic stuff, understanding candlestick anatomy, the websites to use, journaling, trading psychology, but now I want to talk about the most important thing. the actual strategy that you use in the market. So I'm going to do a crash course to the best of my ability and break down the exact strategy that I use in the market. But for a more detailed breakdown, you'll find those videos on this channel. So let's get into it. Okay, so I'm on a backtesting simulation software here, and I'm going to speak through in real time how I'm reading the market and why I'm executing the trades that I'm executing on. So essentially breaking this down in the most simple form, what I'm looking for is first and foremost is some sort of resistance or support level to be formed. What does that look like? In this case, on the 15-minute time frame, that's a red candle being printed. So right now we've just got green, so I'm going to skip. Okay, we've got a red candle printed. Next step is I'm going to mark that level as my resistance level now. So that's an area that's going to be respected. If I can get a new candle break above that level, I'm going to be looking to take a buy position. So let's press play here and see if we can get something happening. Perfect. So there's that candle closure above the range there. This is where it gets important. The very next thing I'm going to be looking for now that we've got a candle engulfing that range, is to see a retest of that level. If a candle can retest that level, then break the high of the previous candle, so that wick at the top there, that's going to be enough of an indication for me that we're very bullish right now, and I'm going to enter a buy position. So there's a retest of that level. There's an attempt to break the high, nothing yet, and there's the high being broken. So what I'll do is enter a trade here. My stop loss is going to go back in that range underneath the current candle wick. My take profit's going to move up for a 1-to-1 risk to reward. Remember we've spoke about this, a 1-to-1 risk to reward, and let the rest play out. I've done my job. So having a hard time getting through here, bouncing around. There's a breakthrough, perfect, and there's target hit. And in simple terms, to break it down, we marked our level of resistance where price is respected. We had a candle engulf that range and break through. We had the new candle retest that range. Once the high of the breakout candle was broken, entry goes there, stop loss goes back underneath that current candle wick, back in the range, and take profit moves up to a 1-to-1 risk to reward. And this is a textbook breakout trade. So now we're a bit later in the session. Let's mark our new support level, which is going to be right here based on these two 15-minute candles. And essentially, it's going to be the exact same as before. I'm going to be looking for a candle to break below this level here. And if we can break that level and retest it, I'm going to be interested in taking a sell position here. So let's see how things play out. Okay, so no break yet. Okay, perfect. There's our candle closure below this respected level. The same thing, rinse and repeat. I'm going to need to see a retest of that level, and if it can break the low after a retest, then I'm going to be interested here. There's a retest. There's the low broken. Same thing as before. Stop loss can go back up in the range above the current candle wick. Take profit can move down to a 1-to-1 risk to reward, and let the rest play out. We've done our job, waited for the retest, waited for the breakout, and capitalized on the continuation. Hopefully. Boom, target hit, and that's the exact strategy I use every single day in the markets. Now the next step is to collect this data. That's all the trade is. It's a piece of data that we throw into the journal to start to collect and build a bigger picture of your strategy, the statistics of your strategy, and how it looks over 1,000 trades. So we'll come in here, isolate this area here, screenshot collected, head over to the journal, input the data, the date, the pair, the text, clean breakout, the size, 5 lots, the type, it was a short position, the setup, for me it would be considered a type 1. The day was a Friday, the stop loss was 30 ticks, take profit was 30 ticks because it was a 1-to-1 risk to reward. Partials, no. The exit, TP was hit, it was a win. The entry time frame, the 15-minute, the session was London. The net profit, 1,000. And finally, and probably most importantly, uploading the screenshot. Perfect, and there it is. And that's how you collect data, that's how you track your statistics, and that's how you actually build a proven, profitable system. So there's a complete guide on how to start your trading career off the right way. I have multiple other videos on my channel if you want to go into depth more about the strategy. But if you really want to take things to a whole nother level, I'll be working with a select few traders for a one-on-one mentorship. So if trading is something you want to take really serious this year, there's a link in the description, and I look forward to hearing from you.